My greetings to everyone in the ongoing series of Finance for Everyone, which is essential for everyone to understand from any diverse field. Today we will be talking on a very important topic called understanding the risk return and its very importance. An essential concept in finance, the risk return trade-off, describes the dynamics between an investor's desired rate of return and their tolerance for the risk. Higher returns are possible, but only if the investors are also willing to take on more and more risk. As a practical matter, this matter that stocks and other investments with the higher expected returns are riskier than the bonds and other assets with the lower expected returns. So this is due to the fact that stock prices are more sensitive to changes in the market and thus more volatile than the bond prices. The risk return trade-off is consequential because it plays a very major role in the financial investment choices. When deciding whether or not an investment is good fit for their portfolio, the investor must balance the possible return with the risk involved. Investors can better adapt their portfolios to their risk tolerances and the financial goals if they have a firm grasp of the risk return trade-off. Although the increased risk is typically accompanied by the larger rewards, this is not always the case. Low risk equities and high quality bonds are the two examples of investments that can provide substantial returns with the minimum risk. So there is no universally applicable risk return trade-off because it is based on the choices and the aim of the investor. Now let us do the characteristics of what is the concept of trade-off. Sure, here are some of the key points that describe the risk-reward trade-off. The first is your risk. In finance, the risk means the chance of losing the money or not getting the expected return on an investment. Bigger the risk, the bigger the possible loss for an investor. So let us have a look on the returns. Return is the amount of the money an investor makes on an investment over a length of time. Higher the gain, the more money an investor can make. Now coming on to what is the concept of trade-off. The risk-return trade-off is the relationship between the return an investor might get and the amount of the risk they are willing to take. In general, investors can only expect to earn the higher returns if they are ready to take on more and more of risk. Coming on to the next point. Investments with more risk. Investments that are seen as riskier, such as the stocks, they have the potential to earn more money than the investments that are seen as less risky, such as bonds. The next is your balancing the risk and return. When making the financial decisions, investor must consider their own risk tolerance, investment goals, and the time horizon. Next is there's no guarantee. It's important to remember that investing always involves some amount of risk, and even as the investor takes on more and more of risk, that does not mean they will get the higher returns. So let us move on to the importance of risk-return trade-off. The risk-return trade-off is an important idea of the business and investing for the several reasons. The first is balancing the risk and return. Investors need to understand the risk-return trade-off in order to find a good balance between the amount of risk they are willing to take and the return they might get. Investors can make the portfolios that match their own goals and the risk tolerance by finding the right mix between the risk and the return. Next is getting the most out of your investments. Investors who understand the risk-return trade-off can make the better decisions about their investments, which may help them get the most out of their investments over a period of time. Investors have a better chance of reaching their investment goals, and if they choose investments with the higher possible return. Coming on to lessening of the risk. Investors who understand the trade-off between the risk and the return can also lessen their overall risk exposure by choosing the investment with a lower risk but still a good amount of return. This can help keep their stock from losing a lot of money when the market goes down. So, the next is your long-term planning. The risk-return trade-off is an important part of the long-term investment planning because it helps the buyer figure out the best mix of the investments to help them reach their long-term goals. Next is your diversification. It's also important to think about the risk-return trade-off when you are trying to spread out your investments. By spreading their risk across a number of different asset classes and individual investments, investors can possibly earn the higher returns while lowering the chance of losing a lot of money. In the end, the risk-return trade-off is a very, very important idea for all the investors to grasp. When making the investments in the financial markets, investors may encounter a variety of hazards, systematic risk and unsystematic risk. There are two types of risk, and these qualities describe each type. The first is your systematic risk. So, starting with the definition aspect of what the systematic risk is all about. Systematic risk, also referred to as a market risk. It is a risk that has an impact on an entire market or the asset class. The diversified portfolio cannot protect against this kind of a risk. Changes in the interest rates, inflation, geopolitical crisis, and economic recessions. They are few examples of the systematic risk. Regardless of an investment's unique qualities or the activities of an individual investor, the systematic risk has an impact on all market assets. Investors can manage systematic risk by diversifying their portfolio among the various asset classes and the industries, but it cannot be avoided or completely removed. Now coming on to the second type of risk, which is called as non-systematic risk. Non-systematic risk, sometimes referred to as a specific risk or diversifiable risk. It is the risk that impacts certain companies or the assets within a market. Next is your company-specific elements. The company-specific elements in including the management changes, operational problems, and shifts in the competitive environment are some of the examples of non-systematic hazards. Let us do now the concept of the other part of non-systematic risk. Since the non-systematic risk only pertains to a particular business or an asset, it can be minimized or reduced through diversification. Holding a varied portfolio of the assets from the various companies and the industries might help control the non-systematic risk. So in conclusion, we can say about the non-systematic risk affects the specific business or the assets and can be diversified among through a well-diversified portfolio. Systematic risks impacts the entire market or the asset class and cannot be avoided. In order to properly manage the risk in their investment portfolios, the investors need to be aware of both the different types of risk and their particular characteristics. Now coming on to the measures of the risk. In finance, the standard deviation and the beta are two often used gauges of risk. The standard deviation quantifies how much a return deviates from its mean or the expected value. It is a statistical measure that shows how much an investment's return depart from the average return over a specific time period. The investment will be more volatile or risky if the standard deviation is bigger. The sensitivity of an investment's return to the changes in the returns of a benchmark index, often the market as a whole, is measured by the beta. On the other hand, the degree to which an investment's return follows the market is reflected by beta, a standardized measure of systematic or the market risk. When the beta is 1, it means that the investment returns will fluctuate in line with the market. A beta of greater than 1 means that the risk or the volatility will be higher, and the beta of less than 1 means that the risk or the volatility will be lower. So in conclusion, we can say the beta reflects the relative risk or sensitivity of an investment to the market changes. The standard deviation represents the overall risk or the volatility of an investment. When determining whether to make an investment, both metrics should be taken into account in addition to the other variables. The calculation and the interpretation of the expected returns. The anticipated return on an investment is determined as the sum of all potential returns, each of which is weighted according to its associated probability. The formula to determine the expected returns is as follows. Expected return is equal to, in brackets, the probability of return 1 into return 1 plus the probability of return 2 into return 2 and so on to including the probability of return n and return n. You can use the needed rate of return for the investments to evaluate the projected return by comparing it to that figure. The investment is anticipated to be successful and may represent a strong investment opportunity if the expected return exceeds needed rate of return. So the investment is not anticipated to be lucrative one or beneficial, and if it may not be a good investment opportunity if the predicted rate is lower than the needed rate of return. In all cases, the investment will be considered as a good opportunity if the actual returns are more than the needed rate of returns. So let us now move on to another example and the formula. Let us imagine, for the illustration purposes, that you are thinking about buying a stock with 30% probability of getting a return of 10% and 70% chance of earning a return of 5%. This is how the anticipated return would be determined. So, return anticipated is equal to 0.30 into 10% plus 0.70 into 5%, it is equal to 3% plus 3.5% equal to 6.5%. So the return anticipated is 6.5%. The investment is not anticipated to be successful and may not be a good investment option if the needed rate of return is 8% and the predicted return of 6.5% is lower than the required rate of return. So this is how we take the investment decisions. Now moving on to a very pertinent part of the present lecture, that is the capital asset pricing model. In short, we call it as CAPM, and its use in calculation of the expected returns. The capital asset pricing model, that is the CAPM, a popular financial model that aids the investors in determining the expected return on the investment depending on its amount of investment and the risk. It goes by the abbreviation CAPM. So, the model offers a mechanism to assess how the risk and return are related, and it is predicted on the idea that the investors expect a bigger return when they take on a greater amount of risk. Let us now do how the risk calculation takes place. The CAPM formula looks like this. The formula for calculating an investment's expected return, it is equal to expected market return minus the risk-free rate of return plus beta x. The risk-free rate which is used in this formula is the rate of return on a security that carries no risk, like a government bond. When compared to the overall market risk, the beta component shows how risky the investment is. The average return of the market as a whole is the expected market return. The CAPM model makes the assumption that investors are logical and risk averse, meaning that they will only accept more risk if they anticipate a higher return. It also presupposes that every investor has access to the same information and shares the same expectations for the state of the market in the future. Now, following are some of the characteristics of the capital asset pricing model. The first is, it is a straightforward and a user-friendly model that offers a technique to calculate projected returns on an investment in accordance with the degree of risk involved. Now, it is frequently employed in the financial sector, notably in the portfolio management and the security analysis. So, it makes the unrealistic assumption that all investors have equal access to the information and that the market is efficient, which may not always be the case. Now, it makes the erroneous assumption that the investors are logical and they are risk averse, which isn't always the case because they might be swayed by the prejudice and the emotions. So, in general, the CAPM model gives investors a valuable tool to calculate the expected return on investment based on the risk involved. To make the investment decisions, it should, however, be used in conjunction with the other models and, of course, the analysis. Let us move on to efficient frontier portfolio optimization. Now, using the principles from the finance, such as the efficient frontier and the portfolio optimization, investors can manage their portfolio to get the best potential risk-return trade-off. The collection of the portfolio, known as the efficient frontier, offers either the lower risk for a given level of expected return or the highest expected return for a given level of risk. Now let us start with portfolio. The potential investment combinations. The portfolio investment combinations that provide the optimal risk-return trade-offs are represented graphically. The process of choosing the optimal combinations of the investments to create a portfolio that is on the efficient frontier is called as the portfolio optimization. The objective of the portfolio optimization is to either minimize the risk of a portfolio for a given level of expected return or to maximize the expected return of a portfolio for a given level of a risk. Now moving further, the optimization of a portfolio is a multi-step procedure. The investor must first decide what his or her investment goals, risk tolerance, and the time horizons are. They must then build a series of portfolio that represent the various combinations of these investments after analyzing the risk and the return characteristics of the available investments. Now the risk and the return of each portfolio. It must then be calculated and plotted on the efficient frontier. Finally, based on their investment goals and the risk tolerance, they must choose the ideal portfolio from the efficient frontier. Although it can be done manually, the portfolio optimization is frequently carried out by the computer programs that apply sophisticated optimization algorithms to determine the ideal portfolio. Now these programs take into account the variables including the predicted returns, volatility, investment correlations, and the restrictions like minimum and maximum allocations to the particular assets or asset classes. So in conclusion, we can say the efficient frontier and the portfolio optimization are very crucial financial concepts and aid the portfolio management and the asset investors achieve the best possible return trade-off. Now, investors can either increase their expected return for a given level of risk or decrease their risk for a given level of expected return by building a portfolio that is on the inefficient frontier. An efficient frontier line and scatter the plot can be used to visualize the display, the efficient frontier and the portfolio optimization. Each point on the scatter plot represents a portfolio made up of various weights of two or more assets. The portfolio risk is shown on the x-axis, which is commonly expressed as the standard deviation of returns, and the expected return is shown on the y-axis. So the portfolio with the highest expected return for a given level of risk and portfolios with the lowest risk for a given level of expected returns are found and shown on a scatter plot, respectively, to build the efficient frontier. So the efficient frontier is the line that connects these portfolio. Now, what is the importance of diversification in managing the risk? It entails distributing the investments across a variety of different assets, industries and the geographical areas. Diversification is a key risk management approach. The risk of a portfolio can be decreased overall by doing this because the performance of any one asset or the sector will have less of an influence on the portfolio as a whole. A portfolio will probably suffer if, for instance, an investor exclusively owns the equities in one sector, say technology. That sector seems a slump. So the impact of the technological slump will be less severe if the investor also owns the companies in the other sectors also, like healthcare and the consumer goods. So investing in the various asset classes, such as the stock, bonds and the real estate, which have the various risk or return profiles, is another way to accomplish the diversification, as one of the asset class performance is unlikely to move in the same direction as another. So this can really help lower a portfolio total risk. Diversification serves to defend against the volatility of the individual investments and offer a more consistent and predictable returns over the long term, making it too crucial for the risk management. So overall we can say the concept of the diversification, the concept of portfolio management, it is one of the way of optimizing it, and definitely it is a multi-step procedure. So the investor must first decide what their goals are, what is their risk tolerance level, what is their time horizons, and definitely that must be represented showing the various combinations of their investment after analyzing a deep concept of risk and return, and then they should put the money into the portfolios. So portfolio management, the risk and return profiles of each stock market and the overall concept of the risk tolerance is very important for the portfolio optimization of an investor. Thank you so much.